Hi everyone. Welcome to a discussion on this concept now, which is purchase consideration. Now, friends, you would need to remember that while the concept is important, of course, this is something which is commonly tested in your calculation-based questions under consolidation, right? So, what are the types of purchase consideration and the calculations of those, etc., is all something which is relevant for us, right? So we need to really understand that well, both from the conceptual as well as the practical standpoint. Okay, so let's talk about this now. When I say purchase consideration, it simply means that what is that amount that the acquirer is paying to the shareholders of acquiring to affect the business combination, right? What is that amount that the acquirer is paying to the shareholders of acquiring to affect the business combination? Now, you can take a step back and start asking yourself, what is that you pay when you acquire a business, right? You might be paying something in shares, you might be paying something in cash, or it could be a combination of those. We have talked about these aspects as well. Now, there could also be instances of, importantly, a delayed payment, a deferred consideration, as we want to use the term now, or it could also be a contingent consideration, right? So these are the broader types of consideration that we need to know, right? And we're discussing some basic examples to understand how to measure these, how to value these for accounting purposes. All right. A purchase consideration is simply the amount which is paid, and it is measured at the fair value on the date of acquisition, right? That's the reason why, importantly, we wanted to know, when did you acquire the business, right? We need to calculate the fair value of the purchase consideration on that particular date of acquisition, right? Now, how do we really calculate the fair value? It is nothing else but the sum of the the fair value of the assets, for example, transferred by the acquirer, or the liabilities assumed to the former owners of the acquiry, and of course, the equities, shares for equity interest issued by the acquirer. This is something which is going to be the sum total, and that would include, of course, your cash payments or the bank transfers, as the case may be. Okay, there could be different forms of consideration, as we said, including cash or some other assets, or a business or a subsidiary of the acquirer. It could be a contingent consideration. It could be a deferred consideration. It could be ordinary or preference equity shares. It could be options, warrants, etc. Right? Or member interest of mutual entities. Right? So these are more typical, but you would commonly see cash, contingent considerations, ordinary or preference equity shares, or even deferred consideration, both in practical life as well as in the examination context there. Okay, so when we look at assessing those fair value of what you're paying, there are limited exceptions to that. Okay, there could be instances when the acquirer's share-based payments are exchanged, for, or let's say, towards payment to the acquirer's employees, right? The measurement of those is based out of the share-based payment accounting standard. So this is something they're going to see in some calculations later. But any share-based payment awards which are exchanged in terms of what you are offering to the employees of the acquired business, right? So the accounting treatment or the measurement of that is both dealt with under Ind AS 102, which is share-based payments accounting standard. All right, let's try to use this uh, you know uh, forum to, for example, talk about what exactly is the basis of calculation of purchase consideration here, right? Very, very simple example that we want to address here. Say we have, there's a company X issues 10 crore shares, right, to acquire control over company Y. Okay. The face value per share is rupees 10. The market value per share is rupees 25. Okay. So how do you look at what is that you are giving to the other shareholders, right? We simply say the number of shares multiplied by the fair value of that, which simply means the purchase consideration is 250 crore rupees. The book value has no significance as far as determination of the purchase consideration is concerned. What I'm giving back to somebody is the market value of that matters, right? So we always take the fair value or the market price of the equity shares issued there. Okay. It can happen. There's a cash payment made of 100 crores, right? In addition to the shares issued by, right? It simply makes the consideration in terms of equity, which is 250 crores. In terms of cash, it's 100 crores. All right. Now, it could also be a further argument that you're going to pay additional cash of 110 crores after 1 year, right? You don't have cash immediately to be paid, but you eventually will be paying another 110 crores. Now, this is an example of course, a delayed payment, a deferred consideration. Okay. It's a delayed payment. So naturally, even that needs to be considered as a part of your purchase consideration, but at its fair value, right? And how do we determine the fair value of a deferred consideration? By calculating its present value. Okay. So a deferred consideration's present value is measured. So simply we are doing a discounting of that, right? So if I were to say there's a deferred consideration of 110, if I were to take a discount rate of 10%, I'm simply saying there is 110 divided by 1.10 since I'm paying after 1 year. So this becomes 100 crores again. All right. Now, finally, if I look at something called as a contingent consideration. Okay. You know that you have acquired a business or you are willing to acquire a business, right? But then you're not certain whether the other business is going to showcase the same amount of growth in future as well, right? You are apprehensive about the growth of that business, but of course you want to pay for that because there's a possibility that it grows as well. You don't want to lose out the opportunity to let this business go, but you are concerned about the growth aspect. So there is a contingency which is brought. Okay. You may offer to the shareholders of the other entity that you're going to pay additional 220 crores after 1 year, right? If the revenue grows at 40% for next 1 year. Okay, just a contingency, just a condition which is being attached, right? Now the point is that this is certain to be paid, right? when you look at a deferred consideration, the moment you look at a contingent consideration, this is likely to be paid, right? So the way you look at the fair value of a contingent consideration, right? You again talk about something called as the expected value, right? So effectively, we are talking about what is the probability that the revenue will be exceeding by 40%. Okay. If I say that, let's say the probability is 60%, there are 60% chances that the revenue will exceed at a rate of 40%, which also means that there's a 60% chance that these 220 crores will be paid. It simply means that 220 crores, the expected value of that is 60%, right? But then when are you going to pay that? After 1 year, which means that I still need to discount that with that 10% discount rate that we calculated. And this amount comes to, for example, 120 crores. Okay. Now, what you need to remember here is that this is a liability to be paid, and this is also a liability to be paid. Okay. They are both liabilities. But this 100 will surely become 110 after 1 year. But this 120 either becomes 220 after 1 year, or it may become nil after 1 year. Either the revenue of 40% will be achieved and then 220 crore would be payable, or it will not be achieved and nothing would be payable, right? So what you want to remember here is that on the date of acquisition, my total consideration would be calculated at equity of 250, cash of 100, deferred consideration of another 100, and a contingent consideration of 120. Okay. Eventually, this 220 is either payable or nothing is payable at all. All right. So what you need to remember here is that there could be different types of consideration. What you eventually pay could be very different from what you are showing on day one. Okay. So purely for the purposes of measuring the purchase consideration, we are calling it 250 plus 100, that makes it 350, plus another 100, that makes it 450, plus 120, that makes it 570, right? This is my day one purchase consideration. Okay. Any increase in the deferred consideration, is purely because of a delay in the payment, right? And that would be accounted for as an interest cost. Okay. Any increase in the deferred consideration is purely on account of delay in the payment. That's the reason why the time value of money comes in, and that differential would be accounted for, let's say, through the interest cost or finance cost, right? But then if you look at the contingent consideration, this value of 120, eventually if it is payable, which is 220, then that difference of 100 crores, which is 220 minus 120, will be charged to the statement of profit or loss. It's an expense for you in terms of the additional liability that you need to incur if that contingency is removed. Once that contingency is removed, you're supposed to pay 220. How much were you showing? 120. So this extra 100 crores is going to be an expense in your books. It's an increase in the liability, straightforward. But what if that contingency does not meet? What if the revenue does not increase by 40%? Well, you don't pay anything at all, which means this 120 crores would also be taken through P&L or a statement of profit or loss, and it is shown as an income. It's a reversal of the liability, clearly making it as an income in the books of the acquirer. Okay, it's an important concept for calculation purposes also. So be very, very, very comfortable around it. All right, let's have a look at the scenario. This is purely a synopsis of what we have covered on the contingent considerations case. Additional or new information would become available during the period, and basis that we need to look at it. My initial measurement is always done on the fair value as on the date of acquisition, right? We'll talk about the classification in a minute. But then when you look at, for example, the amount payable, right, it is measured through P&L as per Ind AS 109. This is something that we've talked in the financial instruments accounting standard as well, right? So any such kind of a contingent consideration is basically FVTP liability, and accordingly, of course, accounted for, right? It is not making any adjustments to goodwill other than the provisional accounting aspects. We'll be discussing all these things at a subsequent point in time. The goodwill is something which is the last step of the conversation, so we don't have to worry about it at this point in time. Okay, let's have a look at this example and see if we can really build that well. It says that on 1st of April 19, Jack acquires 100% interest in Sun for a consideration payable as follows: an immediate issuance of 5 lakh shares with a face value of 10 rupees, a further issuance of 1 lakh shares if the revenue exceeds 2.5 crore rupees, right? And these issuance would be made after 1 year time. On the acquisition date, the fair value of shares is rupees 20 per share. The management has estimated on the date of acquisition, the fair value of contingent consideration is 20 lakh rupees. At the end of the year one, it is noted that Jack has actually met the conditions for the issuance, and the fair value has turned out to be 25 rupees per share. The question is, how should the contingent consideration be treated at initial recognition and eventually at the time of settlement? Right. The easy pick is there is a certain issuance, so we have an equity interest. Let's take that as well. Equity is to the extent of 5 lakh shares, and we have provided that the value per share is 20. That makes it, of course, 1 crore rupees. Okay. And the second part is, of course, about further issuance of 1 lakh shares, and the fair value of the contingent consideration is 20 lakh rupees, which simply makes it a contingent consideration of 20 lakh rupees, which means that my total purchase consideration will be measured at 1 crore 20 lakh rupees. All right. Now, importantly, what I want you to kind of look upon is what we skipped a while ago, right? We need to understand that what is that consideration all about? Is that consideration in form of equity? Well, the answer is yes, because you're going to issue some shares, right? Provided that contingency is met, right? But then the moment it is getting settled in shares, it is never remeasured. It's all about equity, and we don't remeasure equity at all, right? If it were a liability, then we look at the FVTPL criteria, right? But if it were equity, we do not remeasure that. Equities are not remeasured in the accounting. So which means that even though those contingencies are met and the fair value of shares have increased from 20 to 25 rupees per share, it does not change, right? It does not change the value of the share consideration at all. Okay, the contingent consideration is still, being accounted for at 20 lakh rupees as it was originally or initially measured there. All right, that is something which is a critical point for you to remember. It's not at all different from what we have studied under, the financial instruments accounting standards. The same treatment doesn't really change at all, right? The only thing that you might just want to consider that if my share price was 10 rupees and my fair price, so this is the face value, this is the market value, and I'm talking about, let's say, 5 lakh shares, right? That's what we said, 5 lakh shares being issued. I might just want to consider that the 5 lakh shares at a face value of 10 rupees per share, which makes it 50 lakh of share capital. But since the fair value is 20 rupees, there's an additional 50 lakh rupees, which would be in form of share premium, for example. Okay, that is something that you want to kind of split, and you would want to remember that when you are measuring these considerations, be it a consideration in form of equity, on the date of acquisition, or it could be a contingent consideration also. Does not really change a lot. Okay, now this is the next section within the you know uh, contingent consideration, where we are looking at making payments to the employees or the shareholders, right? Put simply, you are talking about, let's say there's a company X which acquires the stake in company Y, making it a business combination, right? Now there are existing employees, right? And there could be an existing or a running ESOP scheme as well. Okay, when you look at, of course, the employees of working in that company, right? Now what you need to remember is that if company X issues its own shares, for example, in this scenario, right, in lieu of the running scheme, right? Now, does that new scheme, new employee stock options, right? Does that new scheme result in a share-based payment, or does it result into, for example, a purchase consideration, right? All those aspects need to be understood well, right? So whether there are arrangements for contingent payments, of course, in this case also, when you're issuing ESOPs, there is an expectation, right? There could be an expectation of again, the market conditions or service conditions and stuff like that. So when there are arrangements being done to the employees or the existing shareholders, and there are contingencies involved, how is the accounting, how is the treatment done for that? It all depends on the nature of the arrangement itself, and you need to take into consideration what is the the continuation of the employment, what is the duration in terms of the remaining period, or what is the expectation of the further vesting period, for example. What are the number of shares already owned by those shareholders? What is the level of remuneration? Are you compensating people so that they would stay further with the merged business or the new business, right? Or are you willing to pay them for their services that they have already rendered, right? They're all relevant factors. Incremental payments and the valuation linkage, they all need to be considered when you are bringing these aspects. The simple question is that when you look at any such kind of contingency payments, how much would that contribute towards the purchase consideration, right? That is something which is the underlying thought process here. Okay, let's have a look at this case. It says Water Limited acquires 100% interest in Sand Limited for 4 crore rupees, and also a contingent payment of, let's say, 40 lakh rupees. It says Sand Limited, of course, is a company owned by a single shareholder, who is also the key management personnel in the company. Okay. The terms of the agreement provides for payment 3 years after the acquisition. If, for example, the PAT margin, the profit after tax margin, is 12%, and the former shareholder continues to be employed for at least 3 years after the acquisition, right? No part of the contingent payment will be paid if the former shareholder does not complete the 3-year employment period. Now, what do you understand here is this payment of 40 lakh rupees, is it because you are acquiring a business, right? Well, you're paying 4 crores any which ways for the 100% stake in the other business. So this 40 lakhs, where does it come? Where does it come from? Or what does it pertain to? Right? We are actually seeing that in this scenario, you shall only be paying this money if that shareholder continues for the next 3 years, right? And nothing would be paid if that person resigns. So, in this sense, this is not going to be, right? This is not going to be towards, for example, you know, contributing towards the purchase consideration, which is purely towards a business acquisition, right? It is rather an example of an employee cost as we determine it under, for example, you know share based payment. It's a classic example of a cash settled share based payment, right? So as far as the purchase consideration is concerned, you only need to take into consideration 4 crore rupees in the given example. All right. Okay, let's have a look at this scenario. It says that there are payment to employees who are former owners of the acquiring. In a business combination, Fox Limited acquires all the outstanding shares of Tiger Limited. Tiger Limited had 4 shareholders with equal shareholding. 2 shareholders are also senior level employees and would continue as employee post acquisition of shares by Fox Limited. Now, each employee shareholder will receive 30 lakh rupees plus additional payment of 75 lakhs to 1 crore based on the multiple of earnings. So there's a contingency element here. Okay. Each non-employee shareholder shall receive 50 lakh rupees. It says further, the additional payment to the employee shareholders will be forfeited if they leave the company anytime during 3 years. The salary, by the way, which is payable to them in general, is a reasonable remuneration for their services. The question is, determine how much of this amount is attributable to the post combination services. Okay. So when you look at these aspects of 30 lakh rupees, for example, right, or 50 lakh rupees, they would be essentially falling within the, the gamut of, for example, your purchase consideration. But as far as the amounts of 75 lakh rupees or 1 crore rupees, depending on the earnings, they are concerned, they much rely on the continuation of service by those two employee directors, right? Right. So when you look at that aspect of post combination service, this contingent consideration, this additional payment, which is the contingent consideration, it shall be considered for that perspective. Okay, that's something that we want to kind of talk about here, is that when you look at the arrangement in which the contingent payments are not affected by employee terminations, that would be an additional consideration. However, the compensation of 75 lakh rupees to 1 crores essentially represents the compensation for the post combination service that will be otherwise forfeited if the employees do not continue. Okay, so only 30 lakh rupees would be taken as a part of your purchase consideration rather than becoming a part of the post employment services there. Okay, it's an important concept for us to understand and, of course, follow there, right? Okay. Let's have a look at another concept. We say that acquirers share based payment awards exchange for awards held by acquirees employee. Now, what does it mean? It means that, for example, there is a company X, right, and there's a company Y, right? We use this context when we were explaining the concept of contingent payments, right? So let us say this company already had an ESOP plan in place. Okay. And let's say this was for 4 years, right? So the original term is original vesting period is 4 years. Okay. Let us say 2 years are already completed. Okay, which simply means that you're only left with 2 more years, right? Now, effectively, this company must have been accounted for or accounting for that share-based payment in its books already. And half of the costs, 50% of the cost must have already been booked by company Y. Okay. But now company X comes and acquires stake in company Y, right? Now the employees might feel, concerned that, they have already served 2 years with an organization and now a new company is coming. Okay. So how should they be looking at this scenario? Right? Although this is not something which is the question here, but to understand the concept, it could be important to follow. Right. So the company X would consider that there is already an investment made by the company in those employees, or there's an investment, there's a notional investment in terms of the efforts which the employees have made while they had stayed with the company for 2 years of time, right? So whatever they pay towards those efforts is going to be an example of a purchase consideration. Okay. And then whatever this company X wants, for example, it may also want the other employees to continue with this service, the employees of company Y, that they need to continue the service for the 2 years still, the further 2 years, which was the remaining term for them in company Y as well, right? So whatever they would be paying for that post combination period would be an example of an employee cost, right? So all we are trying to say is that we need to split between this is the acquisition date, right? So whatever you're paying for the earlier period is indeed an example of a purchase consideration. And whatever you want to pay by offering them the share options in your organization as an acquirer. So any periodicity after the acquisition date would be an example of an employee cost. How do we measure it? We're going to talk about that with the help of some examples. But then this is the fundamental concept that you should be very, very, very comfortable with. Okay. And that's what the slide is trying to share. An acquirer may exchange its share-based payment awards. That is, it replaces the award of the acquired business. Okay. So an acquirer means its share-based payments awards for awards held by employees of the acquirer. It would include both vested and unvested shares, of course. In this case, an exchange of share options is a classic example of a modification, right? What we discuss under Ind AS 102 share-based payments. It's indeed a modification in its spirit also, because whatever originally those employees had, that is getting modified. Okay. And what we want to understand here is that if the acquirer replaces the acquiree's awards, as it does normally, either all or a portion of the value of these acquirers replacements award should be considered in calculating the value, okay, for the business combination as a purchase consideration, right? This piece of the information. And the balance amount shall be considered as a part of the remuneration cost or the employee cost for the post combination period there, right? How do we calculate that? We're looking at those examples in a minute, but the concept suggests for the pre-combination period, compute market-based measure multiplied by the ratio of the vesting period completed, okay, as on the acquisition date, to do either the original vesting period or revised vesting period, whatever is greater. Okay, so whatever calculation comes becomes a part of your purchase consideration. Okay, and whatever is that value, you reduce that from the fair value of the award, that becomes a service cost to be recognized over the remaining vesting period, right? The easiest way to understand this, to appreciate what is all given here, would be to use the help of an example and try to follow that. Let's do this together, and then we can come back to the scenario or the concept again. Okay. It says that in a business combination, Sonu Limited acquired Monu Limited. So Sonu, of course, is the acquirer. As per the terms, Sonu agreed to replace Monu's existing ESOP's scheme, the Equity Settled Share-Based Payment Award Scheme. Monu Limited's original award scheme specify a vesting period of 7 years, and at the date of acquisition, 4 years have already gone by. So we are essentially talking about that proportion of remaining 3 years, of course, right? Now, Sonu Limited has planned to replace Mono Limited's award scheme with its own, own award scheme, which is a replacement, of course. Now the vesting period is reduced to 2 years instead of 3 years. So in a way, you are going to support the employees, and you're telling them, look, in the previous organization, you were supposed to serve for another 3 years, but now as a part of the group, you may only be required to serve for 2 years, right? So that is something which you're looking at, a change in the vesting period as well. Okay, it's a modification, of course. The value of the awards on the acquisition dates were: original award is worth 3,50,000 rupees, but the replacement award is value of 4,20,000 rupees. For the for the simplicity's sake, we assume that all awards are expected to vest. The question is, suggest the accounting for the pre-combination and post-combination period, right? So what do we do here? We are saying that original award had a value of 3,50,000, right? But then it pertains to 7 years as per the original term, right? So this is the value, this is the vesting period. Okay, and we are saying that 4 years are already gone by. Okay, so 4 years of vesting period is already gone by, which actually suggests that this value, which is 3,50,000 divided by 7 into 4, which is 2 lakh rupees, is indeed the value of the services that the employees of the acquiree have served, right? And now the acquirer comes and acquires the business, right? So this 2 lakh rupees is the amount which would be, let's say, settled, or would be, would be the value of the business for which you're going to pay something. Okay, that is something that you want to keep as a context, and that's what the slide is trying to tell us. You go back and look at the concept. It says that what is the market-based measure multiplied by the ratio of the vesting period completed, right? The vesting period completed was 4, okay, to the greater of original vesting period or revised vesting period. Our original vesting period is 7, revised vesting period is 6, by the way, because instead of the remaining 3 years, you are expecting employees to serve only 2 years. So it means it is 7, and you look at that valuation. So this becomes, of course, 2 lakh rupees. And this value is included in the purchase consideration. Okay. The second point, the difference between the fair value of the award. Now, the fair value of the award is also provided to us at 4,20,000, right? But you're saying that out of this 2 lakh, which is this value, pertains to the pre-combination offer, which means that this 2,20,000 rupees represents, this is the incremental amount. This is for the replacement, right? So this 2,20,000 rupees represents the amount that you want to pay to the employees of the acquiree for their services being rendered to the group after the acquisition date, right? So this should be charged over the 2 years as far as the facts of this information is concerned. Okay, let's have a look at the formal solution to understand this. We're simply saying that the value of the replacement award will have to be allocated between the pre and the post combination period. The fair value of 3,50,000 rupees will be pro rata on how much of this relates to the pre-combination period, right? That is something which is a part of your purchase consideration. And the balance amount would be compared with, for example, the true value of the award, the fair value of the replaced award or the replacement award, right? Which is 4,20,000, and look at the balance amount there, which was calculated of the pre-combination period. This 2,20,000 rupees will be charged as a cost in the, in the books of the, the group as a as an employee cost, right? Under the share-based payments parameter or the framework, it would be calculated on that basis. Okay, this is an important aspect. As a concept, we should be very, very comfortable about. Yeah, you can expect a portion of this coming in the full-fledged question of consolidation as well. Okay. Now, there could be, importantly, non-replacement awards as well, wherein, for example, you say that acquiree may have outstanding share-based payments which the acquirer does not exchange. Okay, so the the existing employees may not be receiving anything from the acquirer, right? In that case, any vested shares would be credited to the non-controlling interest. We'll talk about the non-controlling interest framework in some time. That is a discussion which would happen eventually, but not relevant here. And any unvested shares, any pre-combination period is again a part of NCI, and a post-combination period would be a part of employee costs, and then again, eventually falling within the NCI's, discussions or NCI's, the scoping of NCI, right? So effectively, we are saying that it's all a part of NCI directly or indirectly. When we understand NCI better, we would be able to appreciate this even more. Okay, let's take a small example. Probably that would be able to clarify in terms of how do we understand this. It says that Star Limited and Moon Limited are in chemical industry. During the year, Star acquired Moon. As per the terms, Star will take from Moon the existing equity settled payment whose awards vest after 7 years of employee service. At the date of acquisition, Moon's employees have rendered 4 years of service, and none of these awards are vested on the acquisition date. Star Limited did not replace but reduce the remaining period from 3 years to 2 years, and Star determines that the market-based measurement of the award is 4,90,000 rupees. Now the question is, what is the amount to be allocated between the NCI and the post-combination employee compensation expense, right? Again, you bring that thought process around where you look at, for example, when you look at this value of the award, for I'll take you back on the question, we are given that is 4,90,000, right? The actual terms was 7 and 4 years have gone by. So essentially, we are looking at the amount being measured at 2,80,000 rupees. Now, what we are saying is that since there is no replacement award around it. So this 2,80,000, for example, would become a part of your pre-combination period, as we have done this earlier calculation, and it is simply allocated to the NCI on the date of acquisition, right? This is purely based on your original vesting period there, right? If it were on the other hand, a part of a replacement award, what we discussed was it becomes a part of the purchase consideration. But since it is not a part of the replacement award, it becomes a part of the NCI, right? The remaining amount of 2,10,000 rupees becomes a part of your compensation expenses, as it was done in the earlier cases also. Okay, so that's the only difference that you want to kind of pick up in this context there. Okay, now this is the next leg of the conversation where we say talk about separate transactions. Now it can happen, and it is very common to see that there is a one company which is a supplier of goods to its customers, and it might as well acquire the customer itself, or it could be the other way around, right? There could be vertical integrations, as we use the terminology in general. Again, not relevant from an examination standpoint, but it can happen that company X is supplying goods to company Y, right? So this is a supplier and this is a customer, right? And company Y, for example, decides to acquire the business of company X, right? Which is of course possible, because you see the synergies, your purchase costs, etc., would be reduced considerably. But the question is that if you are looking at this scenario where X is being acquired by Y, between X and Y, there could be, of course, already balances in place, right? So there could be something outstanding as a payable as far as X is concerned, and sorry, a receivable, for example, as far as in the books of X is concerned. There could be a payable, let's say, in the books of company Y, right? So there are aspects that need to be understood. So what I was saying is this, that when you look at such kind of transactions, right, you need to look at those balances also. And in case there is an acquisition taking place, you need to be looking at it, whether the transaction would eventually benefit the acquirer or the group, or would it benefit the acquirer, right? And accordingly, the treatment has to be done on that basis. It could be either a favorable or an unfavorable transaction to the acquirer, for example, and basis that either a gain or a loss that needs to be booked when you look at the accounting for that, right? So for example, there could be any pre-existing relationship, as we discussed, or there could be a transaction wherein you're looking at remunerating people, or there could be any acquisition related costs, etc. There could be multiple examples. There could be a court case going on between the two entities, right? These are all separate transactions in the standalone businesses, but when you look at the settlement of those, right? So we just talked about these scenarios where you look at there is a supply contract, or there could be receivable or payable, etc., right? So you need to be looking at it that after the acquisition, they are essentially considered to be a single entity. At least on a group basis, they would be considered as one entity, which means that any supply contract would simply result into the termination of the contract, right? If there are already shares that you have got in the other entity, that would simply be a cancellation of the shares, right? If you look at company X, has acquired stake in company Y, but company Y had some investment in shares of company X, right? That would simply mean that you would cancel those shares as well. Okay. Likewise, any receivable or payable would be also extinguished. The balances, the intra-group balances would be cancelled. And similarly, any contractual rights to use the acquirer's assets would be a kind of a repurchase, from the from the acquiree's perspective there. That's something that you want to kind of pick up. As I was saying it before, if there is a settlement because of these cancellations, right? There could be a gain or a loss for that matter. And accordingly, you need to recognize that gain or loss in the financial statements of the acquirer himself. Okay, let's have an understanding of this with the help of a small example. It says that on April 1st, 19, Mark Limited sues Peter Limited for infringement of its trademark. As at 31st of March 20, Peter Limited had recognized a 25 crore rupees towards this litigation liability. So in a way, Peter acknowledges that there is something payable. On 31st of March 20, Peter actually acquires Mark, okay, for a consideration of 500 crores, and the fair value of the settlement is now 50 crore rupees. Okay, so effectively, when you look at this entire relationship, okay, Peter is showing a liability of 25 crores, right? And then Peter is also saying that it has acquired Mark, and the fair value of the liability, for example, coming at 50 crore rupees. Okay. The question is, suggest what is the expected settlement of litigation? Does it become a part of the business combination? Now, what are we trying to say here is that, right? Essentially, this value of the liability is not 25 anymore, it becomes 50, right? So in a way, this acquisition is resulting into a loss to Peter. I mean, I'm not saying that it is a loss in that context, but the litigation value, the value of that litigation has compounded from 25 crores, it has become 50 crore rupees. And that has to be obviously assessed at the time of the date of acquisition. So this is resulting into recognition of a higher liability when you're looking at the acquisition of the other business. And accordingly, that needs to be, of course, brought into the consideration. So this 50 crores would be considered to have been paid for settling the claim, because effectively between the two entities there is nothing receivable or payable, right? So that would not be considered, but the reduction of the 25 crore rupees eventually, which is 50 minus 25, becomes, for example, a loss to the parent company, which is Peter in this given case, right? Again, a conceptual part, but something that you need to be a bit more comfortable about. Okay, so let's try to revisit this, what we have done. We're talking about, look at the consideration always at a fair value. It could be your, in terms of equity, it could be in terms of cash, it could be a deferred consideration, or it could be a contingent consideration, right? They're all being measured at fair value on day one. A contingent consideration, depending on whether it's an equity, then you don't remeasure. If it's a liability, then you remeasure it at FVTPL. That's what India's 109 suggests, right? Again, whether you pay something is a part of the business combination or a separate transaction, you need to look at multiple factors, right? And similarly, the pre-existing relationships would need to be cancelled out, and a settlement is being considered on that part, right? Again, we talked about all these things in detail, where we said that there could be contingent payments to employees or share-based payment exchange or non-replacement awards, etc. They would all need to be considered from the coverage of whether something forms a part of the purchase consideration, or whether does it become a part of your post-employment or a post-combination benefits to be offered to the employees there, right? The other aspects of business combinations without transfer of considerations or a cost of acquisition, etc., is something that we have already talked about broadly there. All right. Thank you very much.